Is it possible that Rivian and Lucid, the EV auto manufacturers looking to compete with Tesla, could end up going bankrupt? In this video, inspired by a comment from Elon Musk, we're going to go through the financials of both Rivian and Lucid, and we're going to compare them to Tesla when Tesla was at a similar stage of production. And the results are quite shocking. So shocking, in fact, that it is not a surprise that Mr. Elon Musk himself provides a warning for these two companies. Here it is.
Unless something changes significantly with Rivian and Lucid, they will both go bankrupt. They're tracking to bankruptcy.
Shout out to the Velocity channel for pointing out this clip here, but let's go ahead and break down some of the financial differences between these companies and where Tesla was at similar levels of production. And again, the results are quite shocking. Keep in mind, we've got coupon code PP expiring this Friday when I go ring the bell at the New York Stock Exchange. So take advantage of that coupon code. We'll be releasing a ton of new lectures this month in December for the Stocks and Psychology of Money group, the Real Estate Investing Zero to Millionaire group, and of course, the Elite Hustlers group, the new course that just dropped, which gets you special access to Elite Hustler live streams that begin next month. Okay, so first we're going to go ahead and look at Rivian. So in Q3 2022, Rivian ended up producing 7,363 vehicles and delivering about 6,584 of them. What I'd like to do to set the stage is look at when Tesla was similar to delivering around 6,500 vehicles, and I found this quarter here where Tesla delivered roughly about 1,000 more vehicles, but puts them, I would say, close enough. Puts them at 7,785 delivered vehicles 8 years ago. So Tesla was roughly at Rivian's position 8 years ago. However, their actual underlying fundamentals are in drastically different places. So the first thing that we have to understand is on the income statement. So I'm going to draw this out very, very simply first. First, you have to remember this, that if you make $100 of revenue, come on, Mr. iPad, there we go. If you make $100 of revenue, you have to subtract from that something known as your COGS, your cost of goods sold. And if it costs you $80 to produce that $100 in revenue, then you're left with $20. This is your gross profit. And this gross profit is very important. You can also call this a gross profit margin. In this case, the gross profit margin would be 20%, or 20 divided by 100. So that's what's left over divided by what your revenue was, right? After this, of course, come things like the operating expenses, and then you have things like taxes and interest and depreciation, and those things come off after that. And that's how you'll get your EBITDA and your net income. But those aren't things that we're really going to pay attention to right now. We're just gonna focus on what was this margin for Tesla, and how does that compare to the margin for Rivian and Lucid at similar stages of production. And again, the results are mind-blowing. So let's start with Tesla. Now, I've already gone ahead and done the math for you, but go through this transition with me. In the 9 months ending September 30th, 2013, Tesla's gross margin was 21.3%. All you do is take this number here, divide it by this number, and subtract 1, and make it positive. If you do the math on a calculator, that'll make total sense. But anyway, it works out to about a 21.3% margin. So in other words, for every $100 of revenue, it costs them about 69-ish 0.7, right? They were left with 21.3. Then in the 9 months the following year, they had a gross margin of about 27.8%. Now do keep in mind, these numbers do include some vehicle credits, okay? They do include vehicle credits, so we have to give credit where credit is due. Yes, these margin numbers do include electric vehicle credits that Tesla had significant advantages of in the early days of production, which Rivian and Lucid do not have as much of an advantage of. But the differences are still quite shocking. So anyway, 27.8%. Over here, if you go for the 3 months ended, you see with the 3 months ended here, they ended at about 29.5%. For the last quarter, that's the quarter where they delivered about 7,700 vehicles, right? Another way to look at this is the margins obviously between 20 to 30%. Take out the margin for, for their tax credits or whatever. It's certainly positive, right? In fact, we can go ahead and see exactly what those credits are by zooming out for a moment. because I know that's going to be a big deal. We'll go ahead and find over here that over here, automotive revenue included $31 million of sales to Daimler, and it included $93 million of regulatory credits, including 76 ZEV credits, zero emission vehicle credits. So let's just take that 93 million number there, and let's go to this particular quarter here. And let's now take off 93 from that top number here. So 849. Now we're gonna grab a quick calculator here, and we're just gonna take off 93. So 849 minus 93, that brings us to about 756. And now you have costs of goods sold of 598.4. So what are we gonna do? 598.4 divided by 756. That would be a margin of about nearly 9%, so 20.9%. As you can see, the margin is clearly still very strong. It's still above 20%, even when you take out all of the zero emission vehicle credits, right? Okay, good. So we take out all of the credits, you're positive for Tesla. Where then does Rivian sit today? Well, this is quite substantially different, let's just say that. So let's go over here. And you know what, an easy metric, well, yeah, okay, we'll do that in a moment. Take a look at this. I think this will be pretty self-explanatory. So you're gonna see a note here that says revenues and then cost of revenues, right? Cost of goods sold. Take a look at these numbers here for the 3 months ended September 30th, 2022, and tell me if you notice anything odd right here. This top line is the cost of revenues. This right here is the costs of goods sold. And no, that does not include your operating expenses. All of the operating expenses are actually being listed right here. Sorry, I should circle it like this. That $857 million right there, those are your operating expenses. This is supposed to be your gross profit. But what you can see at Rivian is there's actually a lack of gross profit. So at a similar stage of Tesla production compared to Rivian production, Tesla was profitable on a gross profit measure. Rivian is not even close. Not even close. $536 million of revenue versus $1.4 billion of costs of goods sold. Maybe they're trying to ramp factories really quickly. It just seems a little extreme though, because look at this. For a Rivian vehicle, they spend $2.71 per dollar of revenue. That's what they spend. So in other words, imagine this, okay? I want you to think about this. Imagine taking $2.71, putting it into a vending machine and getting $1 out. And the company's like, let's do more of this. Okay, that does not make a lot of logical sense. This is why Elon Musk is like, they need to deal with their costs ASAP, otherwise they're going to go bankrupt. Let's compare to Tesla with the same vending machine example. When Tesla takes $1 at the same level of production or age of production, yes, with the tax credit, but we already adjusted that for margin. You take $1 and stick it in the vending machine, what happens? You get $1.42 out. Well, gee, that's a lot nicer. I like getting $1.42 out when I put $1 in the machine. Now you just keep building and growing and growing and growing, and eventually your your gross profit will exceed your operating costs. Because let's be clear, at this point, Tesla was also still losing money once they subtracted $290 million of operating expenses, right? That's your research and development, your selling and general and administrative expenses, the typical expenses. This is what Rivian has as well. They have about $857 million worth of those operating expenses, but they're not even close to chipping away at those operating expenses because they're so upside down on their gross profit. They have no gross profit, they have a gross loss. They have a disgusting gross loss. They're almost losing $3 per dollar of revenue that they're sticking into these cars, not including gross profit. Or not including operating expenses, I should say. That's nasty. If you now add this together here and you say, okay, so we earned $536 million of revenues, but all of our costs were $1,453 plus our OpEx, $857 equals. In other words, this company brought in $536 million, but spent $2.3 billion. That's spending over $4 for every dollar of revenue that's coming in. That, folks, is quite scary. And it's also scary when you go over here to their cash flow statement, because what you could see is their net cash used in operating activities no surprise, is negative $3.6 billion. More than twice as much as their loss was last year. So it's worsening, not getting better. And then, of course, they spend money investing, capital expenditures right here. Capital expenditures line, let it load, and there it is. Capital expenditures line of over $1 billion. So here's a company that lost $4.4 billion in the 9 months ended September 30th. Yikes. Yikes. Those are a lot of losses. Let's now compare it to see if Lucid is doing any better. So in the case of Lucid, we have 2,282 vehicles produced, on track for 6,000 to 7,000 vehicles of annual production. So to get a similar quarter for Tesla, we're going to compare to the last quarter of 2012. That would be, at this point, that's looking at 10 years ago. We've got 2,400 vehicles sold. 2,750 built in the last quarter of 2012. So roughly similar for Tesla about 10 years ago compared to where Lucid is today. And when we go ahead and look at the financials for Tesla, this is now 2 years before that 2014 math we were doing. What do we notice over here? Whoa, look at this. Tesla's automotive sales are actually greater than their cost of revenues even 2 years earlier. So even 2 years earlier, they still had a gross profit. Now it's small, right? It's much smaller. 278.7 divided by 294.3 minus 1 puts them at a gross profit of about 5.3%. So it's super small. And if you take out tax credits for that, you might be closer to 0. But at least they were close to a break even, right? Where's Lucid around the similar level of production now? Well, let's take a look. Here's Lucid, folks. Lucid, revenue. Almost $200 million in revenue at 195. And what's the cost of revenue? Oh, dear Lord, 2.5 times their revenue. In other words, for every $2.52 Lucid stuck in the vending machine, they got $1 out. And then they ended up spending another $213 million on research and development and $176 million on SG&A. This is bad. These companies are nowhere close to gross profitability. And this is a very dangerous path for these companies to be on. This is why Elon Musk is basically begging these companies, figure out how to control your costs, otherwise you're going to go bankrupt. Let's look at the balance sheets for these companies compared to cash flows. When we look at the cash flow for the last 9 months for Lucid, we're down $1.57 billion on cash flow over the last 9 months. They invested another $800 million into plant, property, and equipment. That puts their total free cash flow at negative $2.361 billion. If we now look for their balance sheet, we can go ahead and see how much time does this company have left before they either have to get loans or dilute shareholders, or should I say more loans, or by either raising bonds or taking out loans or getting new investments, which is diluting shareholders, whatever it may be. Well, they've got about $1.2 billion here in cash. They've got short-term investments of about 2. We've got inventory I generally don't count. So we're gonna go with about 3.2 Kevin asset style. This is just super fast, quick math, right? We're gonna look at liabilities that we have here. We've got long-term debt of about $2 billion. Finance lease liabilities, I'm not gonna take that against them given I didn't account for inventories. So we've got $2 billion of long-term debts already. That's okay, let's just assume we'll pay for that as part of our interest payoff. We've got about $3.2 billion of hard cash that we can spend. How much time does that give us if we have a cash burn of $2.36 billion? Well, it gives us probably about a year. That means by September of next year, Lucid either needs to be producing cash flow, which they probably won't, or they're going to have to raise more money, which means the share price is probably going to get hurt, or they'll have to prove some form of path to profitability that people believe in. Let's look at Rivian's balance sheet. So we jump on over to Rivian. Net cash again, in 9 months, we burned 3.6 plus 1. We're at $4.6 billion of burn. Great. Now, let's go ahead and look at the cash on the asset statement, balance sheet, AKA. So here we go, current assets. We're sitting at $13.2 billion in cash. That's actually pretty dang nice. We're not gonna count inventory, plant, property, and equipment, accrued liabilities, we'll call that inventory. Write-off, total liabilities, looks like we've got about long-term 1.2 billion. Fine, very little debt. 1.2 billion long over here. Again, we'll call that an interest write-off, fine. But they are burning $4 billion in 9 months. Let's verify that again quickly. We jump on over here, 3.6 plus 1, it's actually about 4.6 in 9 months. All right, so if we're burning about 4.6 per 9 months, then that's 13.2 divided by 4.6. That gives us 2.87 times 9-month periods. So let's multiply that by 9. That gives us about 26 months of life right here. That works out to a little over 2 years of runway for Rivian before they have to start raising money. So it looks like even though Rivian is spending a lot more money, they have a lot more cash from their IPO. So they were really smart in raising a lot of cash and insulating themselves because they're burning money like freaking crazy. Like there's absolutely no tomorrow. Both of these companies are on a very bad trajectory with cash flow management. We need to see over the next 6 months a dramatic turnaround in their operating efficiency and their gross profit margins. That means cut R&D, cut SG&A, and get your freaking gross profit margins in line. Because if you can't do that, you're going to end up burning the rest of the cash you have, and you will either borrow more until your stock goes to $1, or you'll have to go bankrupt, and somebody else will have to pick up your IP. Maybe Ford will pick up the Rivian IP, maybe Mercedes will pick up the Lucid IP for pennies on the dollar, and there you go. Bad situation to be in. So, is it understandable that these companies have absolutely terrible risk, especially compared to where Tesla was in the early days? Absolutely. This is why Tesla's valued at what it is. They understand production, they understand manufacturing, and they understand profit margin. You want to invest in businesses that have high pricing power. High pricing power means high profit margin, an ability to grow and maintain margins, improve margins, and in difficult times, maintain margins. We're going into a recession, and these companies are in a terrible position. I would be very cautious with these investments. Just like I cautioned against Rivian when it was over $150. Just type into YouTube, Meet Kevin, Rivian. Thanks for watching. Goodbye.